Thank you for that. Now, the government has defended the government-to-government oil supply contracts, saying that the deal has helped ease the dollar crisis in the country. This as opposition leader Raila Odinga called on the EACC to investigate the deal and hold responsible those he claims circumvented the due process for their personal gain.
Months after the government opted to go the G2G way in the supply of oil, the move has lit flames of back and forth and finger-pointing between the opposition and the government on whether the deal reached its intended purpose, which was to ensure a reduction in the cost of fuel. Azimio leader Raila Odinga took a swipe at the Kenya Kwanza government, claiming the government-to-government oil supply deal was not achieving its intended purpose since the cost of fuel has not been lowered as expected. He now wants government officials behind the deal suspended.
The characterization of this deal as a G2G was meant to shield the three Kenyan companies from paying a 30% corporate tax. I will return to this matter later.
But in a rejoinder, Energy CS Davis Chirchir has insisted that the deal exists and indeed has helped ease the dollar crisis facing many countries globally. In a statement late Thursday, Chirchir says that the government-to-government arrangement eliminated the artificial demand that 130 oil marketing companies were creating by moving from bank to bank in search of the same quantity of USD, but which the market interpreted as additional demand promoting speculative tendencies. As a result, the Kenya shilling depreciation against the USD reduced from 3% to 1% month on month by removing a third of the country's USD demand by moving from monthly spot purchase of petroleum products that were existing about USD 500 million per month. According to Odinga, the government's move to take that route was meant to shield three companies from Kenya for paying 30% corporate tax.
They buy at low prices, delay discharging, then ask to be allowed to offload at higher prices, and the cost is passed on to the consumers. In the case of Oryx, it had bought the diesel at an average Platts price of $97.88. That is 14,182 shillings per barrel in July.
Sentiments that have rubbed the National Assembly Majority Leader Kimani Ichung'wah the wrong way.
The very first corporate entities and corporate groups that he had an appointment to see, sought an appointment to see him, and he met with them, were oil marketers in Kenya. We want to remind Kenyans that at the time, and this group was led by the CEO of Vivo Energy, and you can check because it is a public domain, the president did meet with oil marketers, and they told him they were choked by the policies of the previous regime.
Issues to do with the fuel price in Tanzania, which seem to be going down, also featured on Odinga's statement. The CS clarifying that the disparity in price computation between Kenya and Tanzania is as a result of differences in the pricing methodologies that creates a large effect. The impact of the different pricing methodologies has resulted to a temporary price advantage to Tanzania in a declining market. On reports that Uganda has ditched Kenya for its fuel imports, the government says Raila called out the government of Kenya for saying the move by Uganda denies Kenya a profit of at most 15 billion shillings. But according to Chirchir, the Northern Corridor still remains the most competitive in the transportation of petroleum products to Kampala and the adjacent countries, which have traditionally been supplied through Kenya, and that there has been no change in the transit volumes to Uganda and the neighboring countries through the Kenya Pipeline Company Limited. Former Prime Minister Raila Odinga's statement pertaining oil deals in the country is likely to trigger another debate among Kenyans at a time Kenyans are suffering due to the high cost of living. Paul Kirobi, TV47, Nairobi.